Hello everyone. Welcome to Ayurveda Learning Hub. So, I hope you did like our previous video. It was about the stock indexes. Various stock indexes were explained in it and you did subscribe to our channel, right? So, let's begin with today's video. Today we learn about various things, various types of stocks, what are stock certificates, etc. So, this is a topic I'm going to introduce today about stock certificates. Now, what is stock certificates? One of you asked me about this. So, you were like that your parents had given you stock certificates to keep them safe with you. Now you don't know what to do with them. So, I'm gonna explain it to you what are stock certificates because they are really important documents. So, a stock certificate is a safe deposit or an investment usually made in earlier times. Now, no more stock certificates are issued. They are issued, but they are now digitally issued. Earlier, what was it? Your broker, he used to give you a receipt kind of thing called stock certificate. It had at what price the stock was bought and what was the amount of the stock, at how many stocks were bought, of which company, by who. It had all these listings. So now if you get these stock certificates in your parents' cupboard or in your grandparents' cupboard, you need to know that now you need to take them to the broker who had issued it. Now you need to find the broker. Yes, those days there were a number of brokers. Still we have a number of brokers, but now nobody is going in this digital age to comparatively smaller brokers, especially the small investors. But you need to look for the broker now, and you need to ask the broker to what is the current value of the stock, because stock might have grown. No, it's been years. It was your grandparents or parents who had bought these stock certificates, so the stock might have grown a lot now. So you'll get a gain, you'll get a huge gain. So you need to go to the stockbroker, or if you like to keep the stock with you for further purposes, keep them it safe with you and use it or sell it off whenever you like, you may do so. But these stock certificates are really important documents. You still get it through your mail, through message, by National Stock Exchange, or by the broker who mails you the stock certificate every day after you sell or buy whatever is your total selling or buying thing. You get a certificate, you get a receipt kind of thing, and you need to keep it safely, because it is the only evidence you have about what stocks did you buy or sell. So now we'll do various stocks, and one of the most important stocks, which is common stocks. Now there are various types, preferred stocks, common stocks, but common stocks are really common. That's what the name says. So investors have a choice of investing in securities, bonds, mutual funds, various other options, commodities, buying land, but they choose common stocks. So these common stocks, as the name suggests, is something very common. It is a common choice of securities. People go buy stocks, they get normal returns on it, and they can sell their stocks whenever they feel like, and they need to analyze themselves what was the gain in the past period, what is the expected gain of this particular stock, and how will they gain from it. So whenever investors go buy a stock of a particular company and the company uses this profit to expand its business, it's called a common stock. Now, do we know why corporations issue common stock? We know that corporations issue these stocks for the first time in the form of IPOs. So they are they are private limited corporations or companies yet. Then they release a IPO in the big market, in the National Stock Exchange or the Bombay Stock Exchange. Then they become a public limited company because they are now owned by public in the form of stocks. This helps them gain some amount of money which they use for further expansion and investment in the company. So you know that stocks is a form of equity. Now, why equity? What is equity? So equity is something which company is not very responsible for, or is not at all responsible for. So now stocks are equity. So now the corporations don't have to repay the money holder or the stockholder the price of the stock. You never go to the company now. Okay, Reliance, your company is dead, or supposedly you bought the stocks of a Yes Bank. You never go to Yes Bank. Okay, your company is dead. Now return me my stock money. It's not like a FD or something. You can't ask the company for return. If it goes down, the stock price goes down and you lose it. So this is how the company is not responsible to pay back the money. Now this makes the company quite free to use the fund for their ongoing activities, and for the stockholder to make money on the stock, that's also made easy, na? It's no more on the whims of the company that will it give it back to you or won't it. Now you can sell your stock to any other investor and gain from it. So it's a very simple process. Now for being an investor, the price is set according to how much the buyers are willing to pay these days, which depends on the company's output, the sales, they everything. So you go to another buyer, you set them, okay, at this price, you make a deal, and you people decide to buy or sell the stocks, and the stocks are bought or sold. Now whatever be the revenues, you gain it. Whatever be the profit, supposedly you buy it at 300 rupees per stock and you sell it at 400 rupees per stock to someone who is very very anxious or is very excited to buy the stock of that particular company, because he or she feels that it will gain a lot in a nearby period and she needs to invest in it. So you can sell it off at any price, whatever you guys agree to. Company has no role in this, so you have liquidity, the company has liquidity, it has no responsibility to pay back the stock price to you. So this makes it be called equity, and yes, it is now the company on whose whims and fancies. Now you're not any more dependent on the whims and fancies of the company, that will it pay back or not. So you have liquidity. Now another important thing is dividend is not mandatory. It's again the decision of the company whether it is willing to pay you the dividend or whether it is willing to utilize entire profit is of itself is utilized in growth of the company, more investments, more buying and selling, or whatever be the personal use of trustees and the board, the department, or the board members, whatever be the purpose. Now no, it can't be decided how the profit of the company is used. You can be a decision maker if you own more than 1 or 5% of the company, depending on company's policies, that after what amount of stocks you use, you can suggest or take part in the decision making of the company. So this is how it goes. As a minimum stock buyer, as a small capital investor, you don't have any say in it. You might or might not get dividend. It's not mandatory, but there are companies who regularly give dividend. If you want dividends, you can invest in such companies. You can look at their stock prices, you can choose from such companies. So investors purchase these stocks for certain reasons. They get certain amount of income, or in various forms they get this income. So we learn about in various forms of income and other types of stocks in the upcoming video. Do like this video, do subscribe to our channel, the AccuWeather Learning Hub, and in case you have any doubt or you want to know about a particular topic of the stocks, do write it in the comments and I'll answer your questions in the next video. Thank you.